Over the past 3 months, major asset classes have experienced a number of challenges. When we consider, the start of the year, we were really coming off the end of the surge in the Omicron variant of COVID, which of course impacted economies globally with its high levels of transmissibility. Now, the impact that had as we moved through the quarter was to really put pressure on inflation. And what that led to was an environment where supply chains were a little bit tighter. We had a scenario of course, we're all too familiar with what's going on with Russia and Ukraine at the moment. And that really put a disruptive impact across markets. Now, when we look at the actual individual asset classes, Australian equities actually fared quite well. When we consider tighter commodities markets as a result of the conflict, Australia being an environment with a lot of commodity producers has benefited, both in terms of the overall economy, but also in terms of the currency, the Australian dollar. Now, if we pivot to international equities, particularly European equities, they were in a more challenging position. Ultimately, the conflict at the sort of eastern borders of Europe, obviously impacted sentiment for European markets, and we saw a relatively large hit to European markets. US markets were also impacted, but for different reasons. As we're dealing with inflation that has proven to be more sticky than initially expected. We remember sort of talking about transient type inflation. It's proven to not be so transient, and of course the conflict has added to that. So, with that in mind, an increasing interest rate expectation has had an impact on your more tech-based stocks, things that are longer duration in nature. And so we've seen some challenged valuations there. When we think about fixed income and bonds, well, of course, with a rising interest rate expectation, that has had an impact. And we've seen a little bit of a sell-off across bond markets. The outlook for markets in the broader sense is one of a changed environment or a transition. What we've gone from over the past, we could probably even go as far as say 12, 14 years, certainly since the GFC, is an environment of falling interest rates, which has really provided a tailwind for most assets, whether we're talking about bonds or equities. But that tailwind has also been uneven in terms of who's benefited. And I guess we're all too familiar of the major sort of tech stocks, your Facebooks, your Apples, your Googles of the world. They've been true beneficiaries of that reducing interest rate. So, at the moment, what we're seeing is a change in tone in markets is probably the best way to describe it. And that change in tone is likely to lead to a more nuanced environment. It won't be a matter of, just buy anything, it's going to go up. It's going to be more of a stock pickers market and really provide opportunities to active managers. The good news is that, with commodity prices and Australia being a commodity producer, a commodity exporter, the Australian environment has actually been quite good. And the reason I mention that is, the local economy relates quite closely to outcomes for not-for-profits. And that's because of the tax benefits of franking credits. And so when we consider the average not-for-profit client, they tend to have a greater exposure to Australian equities than they might otherwise. And what that means is, as the environment improves and as local companies are, seeing higher levels of earnings, that then feeds through to their return outcomes. And so, we tend to see that as positive for not-for-profits. The Russia-Ukraine conflict has really caused an issue for economic recovery or indeed supply chain recovery coming out of the pandemic. And so what that's led to is a more constrained environment for policymakers in responding to inflation as a whole. What it has done is prevented the so-called transient inflation from being truly transient. And so what it's done is increased the risk of policy error, which was already a risk, but not prohibitively so. Everybody's aware of the situation there. It just needs to be dealt with. So in terms of changes that we've made to portfolios, at the end of 2021, we actually made an adjustment to our asset allocations. And within our fixed income allocation, we lent more heavily into floating rate credit. And the benefit in that means it's more resilient. In fact, it's almost entirely resilient to interest rate increases, and in fact does reflect interest rate increases. So, but by putting a higher allocation to that sub asset class, we've actually lent into the environment that has arrived, and so portfolios are relatively well positioned for the environment as it stands. When you consider, this quarter, the quarter just gone, what we've seen actually is, whether we look locally here in Australia or if we're looking globally, we've actually seen quite a significant outperformance of value over growth. Indeed, both jurisdictions, we've seen greater than a 10% outperformance. So it really does suggest that, that there is a real turn in the way markets are positioned, and indeed a far more conducive environment for value investing.